Good evening, everybody. This is Srinivasan, Dr. Mishra, and friends from the banking community and others who are assembled here. A very warm good evening to each one of you once again. Of course, it is in times of what we have today, I have to really extricate myself from the work that has been, but I am glad that I could make it to present this lecture. While considering the topic, what I intended to do, then the tallest personality of Sir PT naturally made me think about the contributions that have been made by people like him and others for setting standards for the world, setting standards for the Indian financial system, more specifically the banking. So that's why I chose this topic. In the post-crisis era, the international thinking on banking and finance stands fundamentally changed. Not only did the crisis shake the confidence of all stakeholders in the international financial system, but also compelled the regulators and policymakers to review whether their policy framework was sound enough to prevent the outbreak of another crisis of a similar magnitude. From the global consultations emerged newer and more refined norms of prudential regulations and supervision that may appear onerous at the present moment, but are expected to make the global financial system reasonably resilient in the long term. When all these consultations about reforming the global financial architecture have been on, I have increasingly felt that India has been leading in many of what we now term as the international best practices in banking and finance. India's lead in economics is, of course, well known and well accepted. Kautilya's Arthashastra, written by Chanakya during 300 BC, is regarded as a masterpiece in diplomacy and economic principles. Kautilya describes the primary role of a ruler and regulator as good governance. He alludes to people-centric and particularly the poor-centric policies that would enhance welfare and lead the stability in any country. He emphasizes on the role of the infrastructure, particularly public investment in roads and transport, as an important responsibility of the ruler, and also highlights the role of private enterprise, suggesting a mixed economic framework. When we study the Arthashastra, we are amazed by the vision of Chanakya in laying down the best practices in economic administration that continue to be relevant even after 2,300 years later. Coming back to the recent times, I am equally impressed by the sagacity of our policymakers and legislators like Sir PT, who built in certain practices in the functioning of the Reserve Bank and the Indian banking system. We see similar practices being recommended now by the international standard-setting bodies as international best practices. First, the fact that we have had these practices in place has helped us weather the crises which have shaken the rest of the world. Secondly, these practices have also made our transition to the contemporary international best practices fairly easier. Most of the issues that I discussed today relate to banking sector regulation. However, there is another area relating to the banking sector that we cannot overlook when we compare Indian banking practices with the rest of the world, and that relates to financial inclusion. Stepping beyond the banking sector and looking at other core areas of functioning like the central bank, such as foreign exchange reserve management and payment systems, also suggest several homegrown practices which are now being regarded as international best practices. Let me begin with the prudential regulations. Statutory liquidity ratio and the liquidity coverage ratio. In the wake of the global financial crisis in 2007-8, the Basel Committee on Banking Supervision initiated the liquidity coverage ratio in an effort to strengthen the liquidity framework of the financial systems of the world. Bank portfolios generally consist of liquid assets that are funded by the liabilities that must be renewed continuously until the longer-term customer loans are fully repaid. Episodes of uncertainty, however, can cause increases in short-term rates relative to the long-term rates, which can translate into a run-on and the insolvency for the financial institutions. To prevent such a run on a daily basis, the banks need to hold unencumbered marketable assets that would find buyers at a short notice. A reserve requirement alone may not help enough as a prudential measure for managing liquidity risk. Banks worldwide, for lack of incentives to hold up funds in unenumerated reserves, have often resorted to circumventing the statute by veering away from one form of funding to other in an effort to modify the base for calculating the ratio. The extensive use of short-term wholesale funding to fund long-term assets in the recent crisis being a case in point. Before the global crisis, USA in particular did not have any concept of liquidity asset ratio requirement from either prudential or monetary control point of view. More recently, liquidity risk management has been manifested in various stress testing methods as per the supervisory guidance. Other developed countries that never had or abolished liquidity asset ratios or traditional reserve requirements so far were Canada, France, Sweden, and New Zealand. Indian banks, however, have always had in place a liquidity risk management system in the form of statutory liquidity ratio. According to Section 24(2)(a) of the Banking Regulation Act 1949, all scheduled commercial banks in India are required to maintain in cash or in gold valued at the price not exceeding the current market price, or in unencumbered approved securities valued at a price as specified by the RBI from time to time, as at the close of any day, be not less than 25% and not exceed 40% of the total of its demand and time liability. Following the amendment of Banking Regulation Act in January 2007, the floor rate of 25% of SLR was of course removed. However, even as at present, all scheduled commercial banks are required to maintain a uniform SLR of 20.75% of their total NDTL in India as on the last Friday of the second preceding fortnight. SLR, although focuses on maintaining a static stock of assets out of a stock of liabilities vis-a-vis LCR's emphasis on preempting net cash outflows on an ongoing basis, has always served India well during crisis because the RBI allowed banks to utilize the assets therein to draw on LAF and MSF funds. Financial systems across the world now have to modify their lending behavior to create such buffers of liquid assets. A quantitative impact study by BIS on the implementation of these liquidity ratio norms find that some banks in developed countries, to be able to implement these norms, might have to exit some businesses altogether because their liquid assets get tied up. The assets categorized as liquid under LCR are by and large the ones that Indian banks have always held for calculating their SLR. Indian banks will not find the implementation of LCR as tedious, especially because RBI has now allowed the Indian banks to include 11% of the SLR, the securities, for the purpose of calculating LCR. Credit management techniques. Another area which has drawn the attention of policymakers and standard setting bodies has been the flow of credit to the economy and the resultant risk that can build up in the system over time if left unchecked. The basic premise of macroprudential and microprudential policies is early detection of such buildups and initiation of suitable corrective action. Two types of techniques, that is quantitative and qualitative credit controls, have been used by the central banks worldwide to achieve their objective of managing flow of credit in the economy. The former, or the traditional method, includes banks rate policy, open market operations, and variable reserve ratio. Qualitative, also called selective credit control instruments, work through regulation of margin requirement, credit rationing, regulation of consumer credit, and direct action. As per the Reserve Bank of India Act, Reserve Bank has constituted to regulate the issue of banknotes and keeping of reserves with a view to securing monetary stability in India and generally to operate the currency and credit system of the country to its advantage. Thus, the use of the credit management techniques to the country's advantage has been enshrined in our Act. Towards this objective, Reserve Bank has consistently emphasized on diligent monitoring of the health of loan portfolios of credit institutions and remained proactive in tightening risk weights and provisioning requirements, particularly during rapid credit growth phases. With a view to preventing speculative holding of essential commodities with the help of bank credit and the resultant rise in their prices, Reserve Bank has issued from time to time directives to all commercial banks stipulating specific restrictions on bank advances against specified sensitive commodities. The Reserve Bank introduced selective credit control for the first time in May 1956 in the context of multiplication of banks' advances. The continued loss of foreign exchange reserve towards planned financing again forced the bank to use an additional credit restraint measure called quota slab system instituted in October 1960. The credit authorization scheme was another instrument of credit control which was introduced in November 1965 to align credit policies closely with the 5-year plans. Under the scheme, scheduled commercial banks were required to obtain the Reserve Bank's authorization before sanctioning any fresh credit of Rs 1 crore or above. As is evident from the above, in the initial phase of scarce credit, Reserve Bank used credit management techniques to ensure efficacious use of the credit. In the recent years, credit management measures have been used to discourage excessive risk built up in particular sectors. In view of significant rise in bank credit to the commercial real estate sector, in conjunction with that in the prices of real estate, risk weights for banks' exposure to commercial real estate were increased from 100% to 125% in July 2005 and further to 150% in May 2006. The risk weights on housing loan extended by banks to individuals were also increased from 50 to 70% in December 2004. The provisions for standard assets were also revised upwards progressively in November 2005, May 2006, and January 2007. In view of high credit growth in select sectors, we had to take all these measures. These measures stood us in good stead during the global financial crisis. Thus, the Reserve Bank, in pursuance of its objective outlined in the RBI Act, has been diligently monitoring the flow of credit in the economy and taking appropriate steps to ensure that flow of credit is used to the betterment of the economy. Regulation of non-banking financial sector. The idea that shadow banking should be regulated is of recent origin in most of the countries and has found credence in the aftermath of the global financial crisis when the role of shadow banks was brought in sharp focus. However, in India, the scheme of regulation of non-banking financial companies originated in mid-1960s when sudden upsurge in deposit mobilization by the NBFCs was noticed. The provisions of Chapter 3B of the Reserve Bank of India Act 1934, which regulated the deposit acceptance activities of the NBFCs, has been in existence since mid-1960s. The focus of regulation was to ensure that the segment serves as an adjunct to the banking system and also provides an indirect protection to the depositors. The objective of this legislative framework was to regulate the deposit acceptance activities of NBFCs. As per the provisions of this framework, the Reserve Bank was empowered to regulate or prohibit issue of prospectus, etc. And in October, sector-specific refinance facilities. One of the most important features of the global financial crisis was the aggravation of the problem of bank liquidity, credit market crisis, and to put it simply, the lack of money. This was addressed through various measures undertaken by the central banks to widen access to central bank financing. Objectives of the refinance facility by the central bank is to provide further comfort on liquidity and to impart flexibility in liquidity management to banks. Refinancing operations were undertaken by most of the central banks to ensure credit flow to the real economy. Some central banks undertook specific measures to ensure smooth flow of credit to exporters, small businesses, and entrepreneurs. The Reserve Bank has been following several sector-specific refinance facilities. These have been reviewed from time to time based on the evolving macroeconomic and market conditions. Under Section 17(3)(a) of the Reserve Bank of India Act, RBI first introduced the scheme of export financing in 1967, which was intended to make short-term working capital finance available to exporters at internationally comparable interest rates. The export credit refinance scheme has been reviewed from time to time based on the stance of monetary policy. It has been merged with the system-level liquidity provision with effect from February 7, 2015. In response to recent global crisis, a special refinance was introduced under Section 17(3)(b) of the Reserve Bank of India Act, under which all scheduled commercial banks were provided refinance from the Reserve Bank equivalent to up to 1.1% of the 1% of each bank's NDTL as on October 24, 2008. Banks were encouraged to use this facility for the purpose of extending finance to micro and small enterprises. The eligible limit of the ECR facility for scheduled banks was also increased from 15 to 50% of the outstanding export credit. Now, in place of Reserve Bank, financial institutions such as NABARD, SIDBI, and NHB extend refinance to banks as well as non-banking financial institutions. Mudra Bank, new institution for development of micro units in refinancing through state-level institutions and delivering loans to NBFCs, MFIs, rural banks, district banks, etc., have also come on the scene. Financial inclusion. The concept of financial inclusion gained global attention during the 2000s through its link with the achievement of the Millennium Development Goals set by the United Nations. The Reserve Bank of India has, however, been undertaking various initiatives over the last 5 decades to help the underprivileged participate in the country's economic development. On April 2012, India became the first BRIC member to join the CGAP, the Policy Research Center housed at the World Bank, dedicated to improving financial access for the world's poor. An analysis done in 2015 RBI committee report on financial inclusion finds that access to finance is an average 0.4 to 0.16 percentage points higher in India compared to other MD peers. Globally, about 38% of the adult population has no or very limited access to formal financial services. This makes a strong case for poor households to penetrate the boundary of the formal finance. Loans or savings can help them to accelerate consumption, absorb unforeseen shocks such as health-related issues, make households investment in durable goods, etc. Indian policymakers have always emphasized the significance of inclusive finance. Our policies like the nationalization of banks, priority sector lending, setting up of regional rural banks, and encouragement to cooperatives date back to 1960s and 1970s, underlining the fact that inclusive finance was always a national priority. The financial inclusion policy introduced by the Reserve Bank in the year 2005 helped launch a 100% financial inclusion drive. In doing this, India stands out as one of the few EMDE for which the government has a documented financial inclusion strategy that contains specific commitments. The launch of the Pradhan Mantri Jan Dhan Yojana program in 2014, one of the world's largest financial inclusion initiatives to date that promotes no-frill accounts, is one prominent example of India's national level commitment to advancing financial inclusion. Foreign exchange reserve management. Official foreign exchange reserves are maintained in any country in order to achieve a set of objectives such as support and maintain confidence in the monetary and exchange rate policies, limit external vulnerabilities by maintaining foreign currency liquidity to absorb shocks during times of stress, to provide a level of confidence to markets, demonstrate the backing of domestic currency by external assets and meeting its foreign exchange needs and external debt obligations. However, the design of investment portfolios varies widely across countries, reflecting essentially the exposure to liquidity, currency, interest rate, and counterparty credit risk, and the scope of active management thereof. Portfolio design takes into account a host of factors such as exchange rate regime adopted by the country, the extent of openness of the economy, the size of the external sector in a country's GDP, and integration of the financial markets. India has been forerunner in terms of international best practices in the management of foreign exchange reserves. According to latest IMF guidelines, reserve management should seek to ensure that adequate foreign exchange reserves are available for meeting a defined range of objectives. Liquidity, market, credit, legal, settlement, custodial, and operational risks are controlled in a prudential manner, and subject to liquidity and other risk constraints, reasonable risk-adjusted returns are generated over the medium to long term on the funds invested. The broad objectives of reserve management in India runs on similar lines. While liquidity and safety continue to be the twin objectives of reserve management in India, return optimization is kept in view within this framework. It can be found even in the preamble of the Reserve Bank of India Act, which says to use the currency system to the country's advantage and with a view to securing monetary stability. Here, monetary stability may be interpreted as the internal and external stability, implying stable exchange rate as one of the overall objectives of the reserve management policy. While internal stability implies that reserve management cannot be isolated from the domestic macroeconomic stability and economic growth, the phrase "to use the currency system to the country's advantage" implies that maximum gains for the country as a whole or the economy in general could be derived in the process of reserve management. The Reserve Bank of India Act provides the overarching legal framework for deployment of reserves in different foreign currency assets and gold within the broad parameters of currencies, instruments, issuers, and counterparties. The relevant provisions are contained in Section 17 and 33 of the Act. The investment universe of the foreign currency assets comprises deposits with other central banks, the Bank for International Settlement, and the overseas branches of commercial banks, debt securities issued by sovereigns and sovereign guaranteed with residual maturity not exceeding 10 years, and other instruments or institutions as approved by the central board. Thus, the parameters and boundaries for managing the credit risk and the liquidity risk of the foreign exchange reserves have been delineated in the law itself, that too long years before. Payment system. A robust payment system is an essential element of financial inclusion. As per various recent global payment reports, India stands among the select few countries who have already undertaken about 50% of the journey towards modernizing and digitizing its payment infrastructure. The Reserve Bank has been at the forefront in adoption of technology and modernizing the payment system. In adoption of certain technologies and safeguards, we have been ahead of many countries worldwide, including even the advanced countries. Two-factor authentication for the card-not-present transaction while making payments was the first of its kind in the world. In the same vein, introduction of the National Unified Unstructured Supplementary Services Data, the USSD platform, for providing an interoperable USSD-based mobile banking system is an important innovation in payment technologies as it links all telcos and all major banks. Similarly, Unified Payment System Interface (UPI) eliminates the need for adding payee details such as bank name, branch, IFSC code, and full name of the recipient while making payments, and requires only to create a virtual payment address to send and receive payments. It leverages on trends such as increasing smartphone adoption and mobile app usage, the Indian language interfaces, and increasing access to internet. These are further examples of adoption of frontier technologies to improve the choice set of consumers and are significant step towards moving into a cashless economy. Many other countries are showing interest in these technologies and trying to emulate us. Bharat Bill Payment System seeks to integrate bill payments for various utility services which are repetitive in nature and bring interoperability in bill payments ecosystem, bringing both the banks and non-banks under its fold. Payment System Mission Document 2016-18 further aims at less cash society with the reduction in the share of paper-based clearing instruments, consistent growth in individual segments of retail payment systems like NEFT, IMPS, etc. To sum up, Reserve Bank has been pioneering several policies which have now been termed as international best practices by the standard setting bodies. I have briefly talked about some of these, but this list is not exhaustive. Some of these policies, when initiated by the Reserve Bank, were termed too conservative or were taken as over-regulation by the central banks. However, the farsightedness of our policymakers ensured that Reserve Bank followed the prudent path, howsoever less trodden. With this observation, I conclude my talk. Thank you very much.